Welcome to Mind Over Matter. This is Cedar with Market Mastermind, and we are doing a weekly segment of the psychology of trading. Been doing this now for, I think, 2 years, and happy to keep going with the theme of maintaining a solid psychology around trading because ultimately it's all a head game, all of it. And anything that involves money is going to definitely tie to emotions. So it's really important that you are addressing what you're doing to your trading account with emotions. So if you're allowing them to run your account, if you're allowing them to make your trading decisions, then we know a couple things are happening. One, you're not solid with what you're doing with your TA, potentially. We know for sure that you're oversized if your emotions are getting the best of you, and or you're not trading with risk capital. So the first thing I want to address is that you should not be trading with any money that you're not okay with losing. Now, that's not to say you want to lose it, but it's not going to affect your ability to pay for your house payment or your car or your food. So your basic living expenses should not be put towards anything that could potentially be lost. And the idea is to manage downside risk. The idea is to be focused on small, consistent profitability at the beginning. So small profits, the repeatable executions, and the ability to put checks and balances on yourself if you're seeing that you're struggling to step back instead of having to be in the market at all times. But that's really hard to do if you have to have money. So really important that anything you're dedicating towards trading as far as capital goes, and for that matter time, because you definitely have to dedicate time, is not something that is going to harm you financially. That it's extra money, it's outside of what your budgeting is. So I wanted to go into a couple topics today. There The main one, I think, at least for me, is there's no prize for the degree of difficulty in trading. And that's particularly relevant in the way that the market's trading right now. I made a comment a couple of days ago on Voice, and I might have even said this last week too. All the wiki, very wide ranges that we're seeing feel like FOMC used to feel like years ago. And now we're trading it every day. So the trading environment has changed. We've actually seen an increase in volatility and wider ranges. And that has a lot to do with the fact that there are no new institutions putting together long-term positions. So those that were going to buy Apple and Amazon and all the different big tech names did so quite a while back. And so you don't have new banks and new large investors, which that larger volume is what creates a more steady, more stable, smaller ranged market. So when you see short time frame money, which is what we're seeing from the institutions, the desks are day trading and short time swing trading because they've already put together their positions. So until something changes pretty drastically around that, where there would be new long-term positions put together, we're likely to continue to see what this is. And so the adaptation is an ever-evolving one. And we are living on the edge of history, seeing what we're seeing with the amount of volatility, the amount of just insanity, to see us 100 plus points off of the lows from the after hours sell yesterday, right now, and then now kind of consolidating in RTH. We did actually get a little bit of pop this morning, but now what we're seeing a typical pre-FOMC rate announcement consolidative kind of phase, but we didn't see that in the overnight, and it's not typical. And so what we want to do is be really careful not to think. And you guys see me post this all the time. I try not to think. Every time I do, it costs me money. I don't want to be trying to decide what I think is going to happen because my money is not what moves the market. I very purposefully do not trade low liquidity, low float, penny type names that I would be able to affect, because that's not something that is an enjoyable trading experience for me. I want to be in where I've got lots of liquidity and can basically hop on the train with the size traders. I want to be trading what is easily accessible, that I'm not stuck with contracts that I can't get rid of, that kind of thing. And that's why you see me trade only ES in Q occasionally, once volatility maybe comes back in just a little bit. But big tech names effectively, SPY, QQQ, because I know that I can sell my contracts if I'm trading options. I know that I'm not going to have, and I'd like to say 1 minute candles of $5. However, we saw 1 minute candles of $15 and 5 minute candles of $40 yesterday on ES. But this is a particularly different environment, or difficult environment, different and difficult, because we're in an election year. We've seen, well, we probably can't even count on one hand how many once in a lifetime kind of things: an attempted assassination, a sitting president who is eligible for re-election choose not to partake in that, and we could go down the list of that. Net out, we're in an election year, and we're in a particularly sensitive rate environment from the perspective of trying to figure out what the Fed is going to do. And it's the entire market. So it's not us trying to figure out what the Fed's trying to do. It's us trying to figure out how to take our piece of the pie while all the shenanigans from a political perspective are unfolding as we're trading and trying to have this be our business. So it's really important, those of you who are newer traders, understand that it's probably not always going to be like this, but we, especially those of us, I've been trading 22 years, those of us who have seen the different environments and adapt, just as soon as you get used to this environment, it'll change and we'll go into stagnation as the new president comes in, or the vice president is elected to president, whatever happens. Because it's like this big sigh of relief. Everybody's kind of in this tension place and like, okay, let's see what's going to happen, what's going to happen. And you can go back and look at the election from like the 2015, but it is such a different environment between rates, between what's happening politically with a step down of a first-term president. It's very, you're never going to see this set of events again in your lifetime. I can just about guarantee that. Can't guarantee much else about trading, but this is unusual. So our goal is to preserve capital as much as possible, which is why you don't see me size up. And I get that question a lot. Hey, your 25K account is now sitting at 40,000 or 30,000, whatever. Why aren't you adding more size on now that you have grown that account? And same question with the 10K options account. And the answer is that money is mine. What I've already made, those gains are mine. And I don't distribute mine out until the end of the month. However, it took me a very long time of practice of being able to do that, because I used to make money, size up, lose all that money I made, and then be back to square one. So it's basically treading water when you're sizing up and then blowing it right back down, or possibly even going into drawdown at that point. So my suggestion is that you pay yourself every week, or if you have a big day, that day at the close of market, get the money out of your account. And you don't have to, you can just transfer it to a separate savings account, have it set aside so that if you do need to have access to more capital, you've got access to your capital instead of giving it back to the market, which is what I see so many traders do. But not being so focused on, oh, I have to have $1 million account, or, oh, I have a $2,000 account right now, I've got to get it to 10 grand. And so now I got it to 3, so I'm going to add an additional MES contract, or, whatever the case is. And everybody's in a different place in their trading experience, their trading journey, their trading business, as the case may be. But you have to have benchmarked levels that you're going to actually increase your risk exposure as far as position sizing. So let's say you're starting with a 2K account trading futures. I like to see no more than 1 micro ES MES per $1,000 traded. And so that would be 1 to 2 MES per trade. And that's nice because it allows you to be able to start with one and add a second one. And you would want to set up something in your your Tradevate account from a risk parameter perspective that will not allow you to trade any other products, including accidentally one ES instead of one MES, and even worse, two ES. So you can actually set it up where you can say, I can only trade this product and I can only trade this number of contracts, and I can only have this much drawdown per day. So you can actually put your drawdown in so that you're not over trading to the point where you gave some money back and now you're going to revenge trade and lose more. So making sure that you're setting those risk parameters in are absolutely critical. Now, one thing I will suggest for those of you trading prop accounts, because you can't do that. So even if you're using Tradevate for a prop firm, they won't allow you to set up risk parameters. It's, I don't know, can't get into the details of what that is. I just know that on my personal account I can, and my prop accounts I can't. So my recommendation before you pay any more prop fees is to go tally up how much money you've put into paying prop fees and blown them up because you didn't respect the capital, or you thought that it was a $50,000 account when it was actually a $3,000 trailing drawdown, which is the value of it. So my guess is a couple hundred, couple thousand, in some instances much more than that. My question to you is, if you had spent the amount of time that you've been trying to pass a prop firm and the amount of money that you've put into it, how much money would you have in a trading account? And this is going to go back to delayed gratification. So trading is not a get rich quick anything. It's a get poor quick. The more you need the money, the less likely you're going to get at trading because of the emotional tie to money. So my suggestion is to take a step back, take a big breath, and refine your skill and fund your account yourself rather than continuing to buy those 20 accounts or 5 accounts in a day or whatever it is that's potentially happening. So flip side is, I'm going to go back to the scenario of a $2,000 account, your own personal futures account that you can trade 2 MES on. You need to decide when you're going to be allowed to reach 3 MES. And the great thing about that risk profile, the risk settings that you can put in, is that you can't change it until the end of the day. So let's say you have a phenomenal day, you're trading 2 micros, and yes, you can make $500, $600, $700, $800 trading micros on the days that are big moving days. It is absolutely doable. So let's say you get to your next level where you could add a third one. You can't do it until after the market close. If you're in a place where you're trading a $2,000 account and you increased it by 50% to $3,000 in one day, I'm going to heavily recommend that you do not increase to 3 MES contracts the next day. I'm going to say give yourself a couple of weeks. You might say, I can change these twice a month on the 1st and the 15th. I can change them over the weekend. I can change them once a month. I'm not going to change to 3 until I reach $5,000. And it seems like that's a forever kind of goal. However, what it's going to do is allow you to kind of grow into what the size of that account is. When you start seeing more money in your account, it becomes what I call the rock star phenomenon, or the rock star mentality. I'm a rock star and I can't do anything wrong. And that's when we get in trouble. So last thing we want to do is have large winning days and then size up. So I would delay it. I would say, hey, if you did it on a Wednesday, we'll use today for an example. I would say, I'm going to give this until the end of the week and see how I'm still trading my 2 MES contracts, see where I can make it. And if I have retained that additional 1,000 and made some more money through the remainder of the week, then I'll go ahead and increase it by 1 ES contract. And what I really like to see is increases at the $5,000 increments. So if you started with 2, to spend 2 MES and build it to 5, which is totally doable, just as a delayed gratification, practicing your process, it really is Process is what makes perfect, not practice, but process. So practicing the process, practicing the self-regulation to be able to step away if you need to be able to lean in when you should, when you're trading well. And so going back to that, maybe my recommendation is to just wait until you're at 5 grand and not even reassess it over the weekend. But that's going to take some pretty solid self-examination, self-control, and probably some journaling and probably some notes all over your computer. So if you're struggling with that, you can send me your individual situation and I'll give you some parameters. And of course, it's up to you to follow it. But just as far as what I would be looking to see you do, and that's what it boils back to, is you have to execute it. You have to be the one in charge. So it doesn't matter what your plan was in the morning if you don't follow your plan, because you're going to end up sizing up. If you don't have those risk parameters in place, most likely you're going to end up giving all of that money back and more. And now at the end of the week, because you increased it to 3 MES, now at the end of the week, you're at 1,800 because you gave enough back after that big winning day. So good to step back a little bit after a large winning day, and good to step back after a losing day as well. So no prize for the degree of difficulty. So just because you see maybe somebody on social media, talking about how they traded in and out of this and in and out of that, and they're trading it well, that's fine. But it becomes, to a certain extent, a bragging contest about the degree of difficulty and how well I traded this and that. And it really shouldn't matter. There really shouldn't be ego involved. Now, you should be happy with your executions. And if you're not, you should be stepping back and looking at it. But we really want to be careful not to let people who are letting their ego speak for them on social media or in other places affect how we're thinking about managing our trading businesses. So I want to remind you to play to your strengths. And this is something, as a business owner, I've been a service-based business owner for 20 years. This is my newest one. But lots and lots of business coaching, lots of development pieces that I've been a part of. And I remember when I was a newer business owner, one of the things that I thought was, I have to get better at the things that I'm not good at in order to be a well-rounded business owner. And the answer is no, I don't. And that was a hard lesson for me, because my thought is, I should be able to do all these things and then I can hire other people to do all of them. The problem with that is there are skill sets, there are things that you are good at as an individual, and there are things you are not. So that natural talent, and you can outwork, you can work beyond on something that you're not good at, but ultimately you're going to be miserable doing it, most likely, because it takes so much effort. And so first thing I did in my first business was hire a CPA and a bookkeeper, 2 separate people, 2 separate firms, so they could keep track of that stuff, because pretty smart, could do my own bookkeeping, blah, 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 blah. I hate it. It's not fun for me. It's not enjoyable, not something I want to do. I would much rather go outside and hang out with my animals, hang out with my family. And so doing what I enjoy is something that luckily I found a long time ago should be my focus. And that's going to translate straight into trading. If I'm finding myself unhappy doing something, that means I'm fighting something, that means I'm trading something that is not really in my skill set. And that's not to say on losing days that I'm not trading what my edge is, right? There can be a well-executed trade that's a loser. There can be a poorly executed trade that's a winner. But if I'm finding myself frustrated with how things are playing out, I'm going to step back and say, okay, so am I outside my lane? I like to stay in my lane of what I am good at doing, because it doesn't feel as much like work. So if you're feeling stressed, you want to step back and ask yourself, do I have a defined edge? That's the very first question. So your trading edge needs to be proven over a lot of trades. When I see people like, oh, I tried that trading style, and I'm like, well, how many times did you try it? I tried it yesterday. How many trades? 6. You need probably a cross section of at least 100 trades with the same exact defined edge rules to see what that looks like. And Trader Forge, Shadow's Trader Forge journaling program will help you do that. If you want something that's more structured to give you like actual data, it'll just, you put the information in and it will give you more information than you could possibly even believe is possible to know where you should be putting your stops, to know, should you be trading in the morning? Should you be trading this product? And it's wonderful. However, you can do that by just handwriting and journaling notes. Here's the trade, here's the time, here's the condition of the market. So I'm going to go back to journaling, and I hit that, I think, every week at this point. But if you're not consistently profitable right now, you have to start journaling. You have to be accountable to yourself. You have to see it written down somewhere to see what's happening, or it's not going to change. And you're going to wake up this time next year still in the same stressful place. And I hope that that is the point of this group, is to really help you move forward to get to the point where you're accountable to yourself, to be able to run your trading account like the business that it should be. So playing to your strengths, if you know that you don't trade in Q well, but you're surrounded by people who are trading in Q, don't trade it. Just because they're trading it well doesn't mean you will trade it well. If you don't trade SPX well, and you see people making a ton of money, but you know by your tracking that you don't trade it well, don't trade it. You can be happy for other people's progress. You can be happy for their profitability in your process of becoming consistently profitable, and have that help move you forward, not make you trade what they're trading, but to develop your own niche, your own what you trade well, inside of seeing the bigger picture of the market. Whatever it is that is affecting you, you need to start maybe trimming some of that out so it's not letting you pull you off so much. And I see that a lot with social media, is, you know, all the gurus on social media, everybody's talking about this, you know, they, like, everybody, there's been people short since, I don't know what, September, October last year, and they're still short. I don't understand. I mean, I understand the thesis, but I don't understand why, when you look at the chart, you could let that cost you as much money as I see it cost them. So going back to your process, you have to refine it and you have to stick to it. So once you've gone through your 100 trade data set and you know, okay, I'm not trading the first 30 minutes well, so I'm going to eliminate that. I think we saw yesterday, I took an early trade, which is the first early trade I've taken in a while, and it turned out well. And then I didn't trade the rest of the day super well. So there's always going to be outlier days that are different. So typically I trade the rest of the day super well in the morning, you know, okay, might make a little, might lose a little if I trade early. So there are going to be outlier days, but you have got to be paying attention to the bigger picture. If it's 1 out of the last 90 days that happens, you kind of just toss that out. It's like, okay, all right. Everybody has days like that. If it is once a week, you're finding that you're not trading the remainder of the day well, and you're only trading the first hour well, you need to be reconsidering around the set of circumstances that are in the environment, what that means for you, when you should be trading. And this is an ever evolving thing. I used to not trade lunch at all. And then I realized I was missing out on a bunch of profits, and I'm 2 hours before the market. I'm Mountain Standard Time. So lunchtime in the market is 10 a.m. for me. So it's a perfect trading time, like mid-morning, excellent. So I started trading lunch. And I know a lot of traders who still won't trade it because of what it used to be, not what it is now. So that goes back into adapting into changing market environments is going to be super, super important. So let's see if did I have another? Oh, regret. If you are waking up with a feeling of regret after a trading day, that is a solid indication that it's time for you to get real serious about what you're going to do with your trading account. And is that continuing to just oversize and throw spaghetti at the wall? Are you going to lean in and take it serious? This is your year. You can do it. And if you can do it this year, you'll be able to do it probably in just about any year. And maybe the other years will hold trades back, like we used to, 30, 40, couple of hours intraday swings. That'll be great. It'll also feel very boring after what we've seen with the price action, but it is what it is. We take what the market gives us and we adapt and grow and manage our downside risk. So looking forward to seeing you guys this afternoon for FOMC. And I will not be trading the event, which is typical. I think I've only traded one FOMC in the probably last 3 years. And I actually traded that one really well. However, when I sat down and did the calculations on all the FOMCs that I've traded, I'm just slightly above break even. And there's a lot of stress involved in all that wiki whipsaw stuff. And I would rather not be slightly above break even for how much energy goes into that. So sitting out, watching it, use the term Odysseus and the Sirens. And it's Odysseus told his sailors to tie him to the mast so he could look at the sirens, but not touch them and be drawn into the water, which is what the sirens were doing and drowning the sailors. So tie yourself to the mast and enjoy the show. Thanks for joining us for Mind Over Matter, Psychology of Trading in Market Mastermind.